G'day and welcome to this week's video. My name's Robert Goudie from Consortium Private Wealth, and this week I was going to have a look at research and development, and I'm looking at this topic from comments that I get from clients quite regularly in retirement. That we have to have big dividends, businesses that pay high dividends, and I'm probably of the opinion that dividends are important, of course, because that's what puts the bread, milk and butter on the table. But what I put before high dividends is I put really high quality businesses as something that we chase first. So where a company doesn't pay a high dividend, often what we get is higher retained earnings, and that retained earnings is often reinvested back into the business, into research and development. So just to kick off here, this gives you a look at 4 businesses and their dividend payout ratios. So top left is Microsoft. They pay at 28% of the profit they make. CSL, Great Australian Business, is paying 43%. It has been lower in the past. Apple is at 16%, and Google pay no dividends whatsoever. So they pay out, they retain everything to reinvest back into the business. And it's with that retention of profitability of money that's reinvested that ultimately, through human endeavour, that to improve their products and services, that grows the business and revenues longer term, and ultimately increases the valuation of the asset. And that's what I was keen to show today, that research and development through retained earnings and not chasing desperately high dividends. And I have a high dividend example at the end to give you a look at, and that'll be a business that most Australians will know all about. So you can see here, this is Google's research and development over a long period of time, but you can see for last year, it's $27.5 billion that they've reinvested back into their business. This is in addition to any acquisitions they've made, which Google has made about 243 acquisitions over the last 20 years. So obviously that's part of building and reinvesting back into the business. So these are huge numbers, and there's so many different business segments that Google have, and that includes Waymo, the fully autonomous self-driving cars, and improvements to their existing products and services, as well as trying to invent new products and services that we'll use in the future. And I absolutely hope to be able to buy or ride in a Waymo fully autonomous self-driving car to take me from Horsham to Melbourne, where I don't have to drive. Sounds relaxing. So here's a look at some of the obviously biggest research and development spenders in the world. We can see here Amazon report it differently, so they talk about technology and content, but there's an estimate that like Google or Alphabet, they're spending around that $27 billion per year. Microsoft, Apple, Facebook, all around that $18 to $20 billion. So this is huge. But what do you get when you have this constant reinvestment? Well, you have improving products and services. I've already pre-registered for the iPhone 13. I haven't upgraded for a whole heap of years, but I'm keen to get the new one. That's where, that's the outcome of constant improvement and making products and services better. So what happens if that happens over many years? The outcome of reinvestment is growing revenue and ultimately growing profitability. So this is Apple's figures over a going back to 2005, and you can see here was a breakthrough period. This was the December quarter last year at 2020, that you can see here that they for the first time ever, they smashed through for a 3-month time frame $100 billion. Now, they didn't just limp over $100 billion, it was 111.4. Huge numbers. And you can see corresponding periods, obviously these are the Christmas bumps here. They've shot the lights out. So, more products. There's one set of earpods that I use. Here's the other one. And I even forgot I had one in. So these things are now normal. I use these Apple products each and every day of my life. And of course, if the revenue goes up over time, guess what? Revenue, increasing profit, and then the share price goes up. Now, there's obviously last year for the COVID crash, but the acceleration of using tech for schooling at home or work at home has gone through the roof. Next example is Microsoft's annualized revenue, and you can see the jumps are huge. So we can see there from 2020 to 2021, that is in excess of 25 billion or increased earnings on what is already huge base. And of course, share price follows up to where Microsoft is now. That's on the 9th of September. Now, I mentioned I had an example at the end of what happens when business doesn't reinvest as they should to continue to improve the products and services, and that is the Australian company Telstra Telecommunications, who was famously known at certain stages had a payout ratio of over 100%, which means they were borrowing money to pay out the dividends, and that meant it left no money to reinvest back into the business. Now, and this is the revenue back to 98 to now, and you can see the stagnation here only through to 17, that essentially there's been no revenue growth. And if we don't have revenue and profit growth, what do we get in terms of a share price? Well, there's your answer to that. So many people over the years would have purchased Telstra for its high dividend. And if you were buying in around here, which was sort of around that $5 to $6 in around that space, and because you were getting a 6 or 7% dividend yield, well, that's great, but you might be still getting a 5, 6, 7% dividend yield, but you've lost 40% of your money, which is a disaster. So dividends are important because that's what buys the bread, milk and butter, but reinvestment to continue to build a business is, I think, even more important. We can fund cash flow and pensions in different ways through cash reserves and more conservative assets if required. But reinvestment to continue to build a business is vital. Thank you for listening. I hope that's a bit of a help. And do not focus solely on dividends, and don't be afraid of companies that retain a lot of earnings and reinvest that back into their awesome business. Thanks for listening. We'll see you next week.